Hi there! This video will be full of example questions from the North Carolina Real Estate Exam Final Review. Hi everyone, I'm Sean Kelly and this will be a final review for the North Carolina Real Estate Exam practice questions for chapters 11 through 20. Again, full disclosure, I am taking these questions from a couple of different sources and none of them were created by me. This way they stay professional and relevant. You may have already seen some of these questions, but I will be diving into the answers and explaining why the answers are what they are. I will have actual midterm and final review videos in the future that are less question-based and more of run-throughs. So remember to subscribe, give this video a thumbs up as a free way for you to show your support. Grab your 10% off link down in the description below for real estate courses. And last thing, since you are watching a final review, you may be beginning to look for a firm and wondering who you should affiliate with. I am personally under Keller Williams and no one had to sell me on joining this team. I knew I wanted to join Keller Williams before I even started taking real estate courses. If you want to know more about how you should choose a firm and what questions you should ask, I will have a video on that linked right up here eventually. You can also shoot any of your questions to my email or to my Facebook. I'll have both of those linked down in the description below. Let's get through this review. I'll speak a little faster than I did on the midterm, and a little trick for the YouTube viewers. You can speed this video up by about 25% down in the settings below. Let's go. All right, question 1. The situation that exists when the P&I payments are not big enough to pay what is due for interest, never mind any principal, is called A. Amortization, B. Negative amortization, C. Due on sale, or D. Accrued interest. So amortization is normal, that's your normal payment plan. So what happens if the payments aren't large enough? Negative amortization, B. All right, question 2. The last action taken by an appraiser in determining the value of property is called A. Substitution, B. Reconciliation, C. Evaluation, or D. Summation. So this is a keyword here, but there is a comparison approach, cost approach, and the income approach, I believe. At the end of evaluation, they reconcile all three, if needed, to come to a final appraised value. So the answer here is B, reconciliation. Question 3. The secondary market would best be described as the market in which loans are originated, B, the market where loans are bought and sold, C, the market where commercial banks and savings and loans are located, or D, the market in which stock portfolios of loan products are purchased. So this is a pretty simple question here. Your Wells Fargo bank will sell your loan on the secondary market to another company, usually Freddie or Fannie Mae. So answer here B, the market where loans are bought and sold. Question 4. Two parties have entered into a demise agreement. Which of the following would end the demise without further liability to either party? A, death of the parties, B, sale of the property, C, condemnation, or D, mutual or bilateral decision. So demise is a rental agreement. You can't just end a rental agreement, typically. This is between C and D. If the government takes the building, then they technically assist with the tenant. But D is the 100% true one here. If two people come to any agreement, you can get out of anything pretty much. So question 5, how long is the typical residential appraisal considered accurate by the lender? So the value on a house to the exact dollar can change rapidly. Like one day a city could announce a nuclear facility is going to be built in your backyard, or there's a shack or a house gets burned down next to you. There's a lot of different variables there. Therefore, the appraisal is really only accurate for one single day. Question 6. A buyer is purchasing a home for a sales price of $178,000. The home has appraised for $185,000 and the buyer is obtaining an 80% loan. If the lender is requiring them to pay a 1% origination fee and a 1% discount fee, how much money will the borrower need at closing to cover these costs? So this is simple, although they try to trick you. So as I always say, stay confident because you know this. The appraised value doesn't matter here at all. The origination and discount fees are 1% of the loan amount. Loan amount is 80% of $178,000. So $1,424 plus $1,424, the two 1%, is $2,848. So the answer here is C. Question 7. Licensed property managers are engaged in all of the following except A, the creation of concessions, B, competitive bidding, C, refusing offers to purchase the property, or D, recommending capital expenditures and planning budgets. So the only one that makes sense here is C. Just have to say that right out the gate on this one. They can't refuse offers just like an agent can't refuse offers. Offers must be disclosed to our clients or the homeowners in this example. All right, question 8. All of the following are required by the Dodd-Frank Act and enforced by the Consumer Financial Protection Bureau, except A, the borrower's closing disclosure must be received by the borrower at least 3 business days prior to settlement. The borrower must receive a loan estimate from the lender within 3 business days of loan application. C, there are 2 separate closing disclosures, one for the seller and one for the buyer. D, the seller's disclosure must be received by the seller at least 3 business days prior to settlement close date. This one is pretty hard. B and C are fairly obvious, but you do need to really think about A and D here. So the borrower is the one that needs the CD earlier so they know all their fees. The seller doesn't really need to know, or it's not as important because they aren't the ones paying most of these fees. Therefore, D is the answer. The seller doesn't need it 3 days prior. The borrower does. Question 9. All of the following are required by the Real Estate Settlement and Procedures Act except A, disclosure of the APR, B, a loan estimate, C, use of a booklet to accompany the loan estimate, or D, a final and accurate closing disclosure. So RESPA does require lenders to provide disclosures and loan estimates. So APR is the only real answer here. APR is under the TILA, the Truth in Lending Act. Question 10. A borrower getting a construction loan would probably be attaining what type of loan? A, a blanket loan, B, an amortized loan, C, an option loan, or D, a term loan. So blanket loans cover more than one type of loan, so no. Amortized loans are more mortgage-based, pay off interest, and then remaining payment goes to the principal, which doesn't really apply here. Option loans are like adjustable rate loans, so it's term loan. You have this for a period of time before getting a permanent mortgage loan once construction is complete. So the answer is D. Question 11. The economic principle of value that states when a buyer is confronted with 2 or more comparables, the buyer will generally choose the lesser price comparable is called the theory of blank. A, contribution, B, conformity, C, highest and best use, or D, substitution. So if there were 2 gallons of milk at a store, neither are organic, both are whole milk, both are regular, both come from the same freaking cow, which one are you going to buy? The cheaper one. So this is substitution. So question 12, which of the following provides that the consumer can see a copy of the credit report once a year? TILA, RESPA, FCRA, or ECOA. Now, a couple of those, actually just one of those acronyms should be something that you might not be familiar with. The other 3, A through C, you should be familiar with. So the answer here, it's only tricky here because of the acronyms, so just know your acronyms. If I said Fair Credit Reporting Act, you'd probably get the answer C. That's the correct answer. It has to do with credit. Question 13. A loan where the term of the loan is shorter than the amortized period would result in A, negative amortization, B, a term loan, C, a balloon payment, or D, prepayment penalties. So this is where you dump a big lump sum of your payoff at the end of your term. It's a balloon payment. That big lump sum is the pop of the balloon. Answer is C. Question 14. Which of the following is correct regarding a property where the promissory note is secured by deed of trust? A, the trustee holds legal title and the beneficiary holds bare title. B, the trustor holds bare title and the trustee holds equitable title. C, the trustor holds equitable title and the trustee holds legal title. Or D, the trustee holds bare title and the beneficiary holds equitable title. So this is all memorization here. Sounds like gibberish when I'm just reading this out loud. But equitable title is for the homeowner, and the bank or third party has the legal title until you finish paying it off. Therefore, the answer is C. The trustor holds equitable title and the trustee holds the legal title until it's paid off. Question 15. In regards to pledging real property as collateral for a loan, North Carolina is a blank theory state. So there's only two answers here that should even come to your mind, C and D, lien and title. So which one are we? We are title. Answer is D. Question 16. When obtaining a loan, the lender takes into account the debt ratios of the parties obtaining the loan. Which of the following statements is correct regarding debt ratios? A. Lenders utilize a housing ratio of 36% and a total debt ratio of 28%. B. The lender calculates the net income of the borrower. C. Lenders utilize the gross income and the long-term recurring debt. D. Lenders calculate the total debt ratios based on the applicant's car payments, utility bills, credit card payments, and living expenses. So A is flipped there, so it's incorrect. The housing ratio is 20%, 28%, while the debt ratio is 36%. So they get gross income, so it's not B, that says net income. The answer here is C. They use gross and recurring debt. Gross, remember, is before taxes. Question 17. Which of the following is correct regarding an option to purchase? A. The option is enforceable by the optionor. B. The option is enforceable by the optionee. C. Both of the optionor and the optionee may enforce the option. An option is not a contract until the option is exercised by the parties. So the optionor is the giver. They gave the optionee the option to purchase if they wanted to. Therefore, if the optionee has the option to purchase, then the optionee is the one that can enforce or choose to purchase. Answer here is B. The option is enforceable by the optionee. The person if I gave you the option to pick a red Skittle or a green Skittle or no Skittle, you have the option to pick whatever you want to do. No Skittle, or you pick the red or green Skittle. All right, question 18. A bank makes a loan to an individual with an interest rate of 7.75% in the amount of $95,000 for a 30-year term. The payment on the loan is $880.59, which includes $150 a month for taxes and $50 per month for insurance. What is the balance on the loan after the borrower makes their first payment? So first we find the P&I, the principal and interest. They've given us the PITI. We just need to find the P by the end of this answer, the principal. So you do that by taking the $880.59 and subtracting out the $150 and the $50. So now that's subtracting out the T and the I. So that is $680.59 of principal and interest, PI. So no matter what, it can't be B or D because that just exceeds any first month's payment. With the P and I, we need to subtract out the interest to find out how much principal we took off the first month's payment. Interest is 7.75% of $95,000. So that is a yearly amount of $7,362.50. So now you divide that by 12 months to get the interest amount of $613.54. Now take that $680.59 of P&I and subtract out the $613.54 of I, of interest, to get $67.05. So $95,000 of initial principal minus $67.05 gives us C, $94,932.95. Question 19. When a trust deed is paid off in full, the borrower will receive a deed of reconveyance from which party? A, the trustor, B, the beneficiary, C, the mortgagee, or D, the trustee. So for this whole deed of trust, promissory note, mortgage, etc., write these out in a column and put what they mean and who gives what to who. This will really help. So the trustor is the borrower. When a loan is paid off, the trustor gets the deed of reconveyance from who? The trustee. So the answer here is D, the trustee. Question 20. When a mortgage note is in default and the lender demands that the entire balance be paid, the mortgagee is exercising their rights of A, alienation, B, foreclosure, C, acceleration, D, forfeiture. So when the lender demands a rush or an acceleration for the loan to be paid, it's C, acceleration. Question 21. A landlord has failed to repair an air conditioner despite numerous requests from the tenant. Under North Carolina law, and really national law, the tenant may take which of the following actions? A. Withhold up to half month's rent until the landlord remedies the situation. B. Terminate the lease as a constructive eviction. Or C. Sue the landlord for an actual eviction and breach of the lease. Or D. Hire a licensed contractor to repair the AC and deduct only the amount of the repairs from the rent. So if a place is no longer livable or the management isn't living up to their agreements, the tenant may terminate the lease. So the answer here is B, terminate the lease as a constructive eviction. So question 22, which of the following would be considered securitizing documents or collateral agreements? A, promissory notes and mortgages. B, mortgages and real estate tax liens. C, deeds of trust and mortgages. Or D, a lease and a purchase contract. So A is just the promise to pay. B is only half correct. The answer here is C, deeds of trust and mortgages. These offer collateral. Question 23. All of the following would be important to a lender in determining the qualifying ratios of a borrower except A, the amount of net income the borrower has after taxation. B, the amount of gross monthly income that the borrower earns. C, the amount of monthly debt that is recurring for car payments and credit cards. D, the amount of borrower's principal, interest, taxes, and insurance payments on a monthly basis. So we kind of just covered this one. It's gross income before taxes, never after taxation. Answer here is A. Question 24. The clause that defeats the lender's collateral agreement or securitizing instrument once a promissory note has been paid in full is referred to as A, satisfaction of mortgage. B, reconveyance of deed. C, defeasance. D, subordination. Guys, the answer is right here in the question. So be sure you read the question entirely, but it's right there. So the clause that defeats, defeasance clause, is the answer, C. It's when you finish paying off the loan, you defeated that loan. Question 25. All of the following would be included in a promissory note except A, the amount of money that the borrower is obtaining from the bank. B, the penalties and charges if the payment is not received when due. C, the term of the loan and the interest rate. Or D, the identification of the parcel of real estate encumbered by the note. So a promissory note is a financial document. So A and through C are correct. The mortgage or trust deed is the property description stuff. So D is the answer here. The identification of the parcel of real estate encumbered by the note. Question 26. All of the following would be protected under the Equal Credit Opportunity Act except A, a married couple. B, a recipient of public assistance income. C, a migrant worker. D, an immigrant of Chinese ancestry. The Equal Credit Opportunity Act covers married people, people that need monetary assistance in national origin, but not international workers that are not U.S. citizens. C is the answer. Question 27. On a regular basis, a property manager has a home service to change the filters and to check the operation of the HVAC system. This type of maintenance would be considered A, deferred maintenance, where you put it off. B, corrective maintenance, where you do something after something is broken already. C, preventative maintenance, where you do something before something has broken. D, functional adolescence maintenance, which means something is just out of date. So deferred is to put off, corrective is to fix something already broken. Here we are preventing the issue. Answer is C, preventative maintenance. Question 28. Which of the following is required by Regulation Z? A, providing the borrower with a loan estimate within 3 days of loan application. Use of a closing disclosure at the time of settlement. C, the inclusion of APR when using trigger terms in advertising. D, consumer access to a copy of their credit report at least once a year. So Regulation Z is pretty much the same as TILA, the Truth in Lending Act, which covers advertising. The Truth in Lending Act requires annual percentage rates in advertising. C, the inclusion of APR when using trigger terms in advertising. Question 29. Property managers have all of the following responsibilities except A. Realize the highest profit consistent with the owner's instructions. B. Creation of a budget sufficient to cover the expenses of the property. C. Absorbing personal liability for losses associated with the property. Or D. Screening tenants to minimize credit loss. So A, B, and D are really pretty obvious, so by elimination we can get C. But know that managers are not really that liable, especially personally. So answer is C, absorbing personal liability for losses associated with the property. Question 30. A home measures 2,600 square feet and is located on 2 acres of land. The original value of the land was $36,000 and it has appreciated 3% per year for the last 10 years. The home had an original value of $60 per square foot and has depreciated 20%. What is the current value of the property, both the land and the house? So land is now worth $46,800 because it has appreciated 3% every year for 10 years. The home is now worth $124,800 because it was $156,000 but depreciated 20%. So we are now looking at a $171,600 valuation of the property. Answer is A. Question 31. The funds for FHA and VA loans are provided by governmental entities, the Federal Reserve, C. Local banks and lenders, D. Approved secondary market originators. So FHA and VA may sound like some type of government assistance program, and so it sounds like it'd be provided by them, but it's actually not. It's still done by local banks and lenders. B and D are so far off they aren't even worth bringing up. So the answer here is C, local banks and lenders. Question 32. All of the following are subject to the North Carolina Vacation Rental Act, except A, a single-family residence the homeowner has rented out to an Illinois resident for the leisure purposes for a 30-day period. B, an Outer Banks condominium that is rented out for 3 months during the summer to a Michigan resident on vacation. C, a Wilmington Beach property rented out for 6 months of the year to a single tenant. Or D, a Pinehurst home rented out during the golf tournament to a spectator coming to watch the tournament from California. Vacation Rental Act is for periods shorter than 90 days. C says 6 months. So that's your boy. That's the one that's not subject to the North Carolina Vacation Rental Act. C. Question 33. Under the provisions of the Truth in Lending Act, which of the following would not be calculated as a part of the APR, annual percentage rate? A. Discount points. B. Mortgage insurance. C. Loan origination fee. D. Loan interest rate. So one of these is what you need when you don't put your full 20% down on a house and is not part of the annual percentage rate. Answer here is B. Mortgage insurance. Question 34. A borrower obtains a loan in the amount of $68,000 at 9% for 30 years. Their payment on the loan is $547.14. Which of the following statements is true regarding the borrower's first payment? A. The first payment will include more principal than interest. B. $510 will go towards principal and $37.14 will go towards interest. C. $37.14 will go towards principal and $510 will go towards interest. D. The first payment will be an interest-only payment. Okay, so they give you some extra info here that you don't really need, again, which is pretty usual with their math problems. So here you just find the interest. $68,000 times 9% gives you $6,120 of annual interest. Divide that by 12 months to get $510 of interest. Therefore, $510 of interest will go towards interest, which is the only answer here. The answer is C. Nothing here at all implies that the first payment will be an interest-only loan. So that one can you just cross off. The only answer here would be B, but that one is just completely backwards. Your principal payments are almost always lower than your interest, especially early on in a loan. Question 35. The type of homeowner's policy that is referred to as all risk is the HO3. It's your pretty standard one here. Question 36. The type of homeowner's policy that is referred to as the tenant policy is the HO4C. Question 37. The type of homeowner's policy that is referred to as the condominium policy is, I bet you can guess this one, HO6, D. All right, question 38. Which of the following would be an example of economic adolescence? A leaky roof and weathered fascia boards. B, a poor floor plan with 5 bedrooms and 1 bath. C, an outdated kitchen. D, factories and excessive noise in the surrounding neighborhood. So economic adolescence are external factors. So which one of these would be external factors? Only one of these answers comes even close to external stuff. D, factories and excessive noise. Question 39. The market cap rate is 6.8% and a property has been valued at $200,000. So what was the net operating income for the property? So cap rate is what some investors use to figure out if an investment is worth buying. Here we multiply $200,000 by 6.8% to get the answer of B. Question 40. In North Carolina, when does a borrower get possession of the home and the seller receive their proceeds from the sale? A, at the time of settlement. B, once the buyer has fully executed and signed the warranty deed. C, once the closing attorney has verified and received the payment of all monies from the borrower and the lender has funded the loan. Or D, at the time of closing, which is defined as recordation of the deed. So this is important to know for the test and for being a realtor. You don't always get keys right after you finish signing docs, so be careful on your Friday closings, because you might not get the house till Monday. The answer here is D. Question 41. The North Carolina Good Funds Act requires attorneys and settlement agents to A, refuse personal checks at closing. B, disperse funds after recording. C, disperse funds upon settlement. D, verify only funds that exceed $10,000. So money is not dispersed until after everything is recorded in a public notice. So the answer is B, disperse funds after recording. Question 42. Which of the following is a true statement about an amortized loan? A, the longer the amortized period, the greater the amount of principal paid. B, the shorter the amount amortized period, the lower the amount of principal paid. C, the shorter the amortized period, the greater amount of interest paid. Or D, the longer the amortized period, the greater the amount of interest paid. So here, just knowing what principal means will knock off 2 of these answers. Principal is the amount of the purchase price you have left to pay. It stays the same no matter what the interest rate is. If you negotiate that you pay $100,000 for a house, you're going to pay $100,000 in principal, period. Interest, though, can change based off of interest rates and terms. Answer here is D. The more time you are amortized, the more interest you'll end up paying. Question 43. A property manager has negotiated leases and had them signed on behalf of the property owner. Under North Carolina law, these leases must be provided to the property owner A, immediately but never later than 5 days after signature. B, within 30 days of signature. C, the property manager is not permitted to sign leases on behalf of the owner. Or D, within 45 days of signature. So this is memorization here. You may be comfortable with selecting 30 days at this point. But for property manager, it is 45 days for them to get you your lease information. Question 44. Which of the following transactions would require compliance with RESPA? A loan obtained on a parcel of vacant land. B, an investor purchasing a 4-unit residential property. C, a retired couple paying cash for a single-family residence vacation home. Or D, a loan on a multifamily apartment complex. So you don't need it on land, vacation, or complexes larger than 4 units. Answer here is B. Even if it were a duplex, this would still fit. Question 45. A borrower obtained a $147,975 loan, which represented a 75% LTV, loan-to-value ratio. What was the purchase price of the property? A, $110,000. B, $184,968. C, $197,300. Or D, $210,000. So this is saying that $147,975 is 75% of the total purchase price. What is the additional 25% that is missing here? So take the $147,975 and divide it by 75% to get $197,300. You can double check by doing $197,300 times 75%, which will give you the $147,975. Answer here is C. Question 46. The provision in a lease that ensures that the lessee will have occupancy of the unit against all others who claim a superior interest in the property is known as the A. Covenant of possession, B. Covenant against encumbrances, C. Covenant of quiet enjoyment, or D. Covenant against ejectment. So only reasonable answers would be A and C, but it's quiet enjoyment. You don't technically possess the property. You can't go and paint the siding, for instance. Question 47. Enforcement of RESPA and Regulation Z occurs by Federal Reserve, HUD, CFPB, or Interstate Banking Regulation Commission. So Federal Reserve is financial stuff, HUD is more urban development, CFPB is the Consumer Financial Protection Bureau. They protect you just like RESPA and Regulation Z. Answer is C. Question 48. Which of the following statements is correct regarding the cost approach? Land value minus the cost of the building equals the value of the property. Land value plus depreciation minus cost of the building equals value of the property. C. Land value plus appreciation plus cost of the building minus depreciation equals value of the property. Or D. Land value plus cost of the building minus depreciation plus appreciation equals value of the property. So these answers should really have parentheses around or some separation here. First, you get the land value, then you get the building value. It's two separate equations here. It is land plus appreciation, and then the building minus its depreciation. Answer here is C. Question 49. In a non-judicial foreclosure, the process is initiated by A. The beneficiary filing a lease pendens, however you say that. B. The trustee instructing the beneficiary to issue a notice of default. C. The trustor issuing a notice of default and a notice of sale. D. The beneficiary instructing the trustee to issue a notice of default and a notice of sale. So the non-judicial foreclosure is the quicker one. Judicial means going to court, basically. So this is done with the trustee giving a notice. Answer is D. Question 50. Provisions that call for the release of certain parcels when a specified amount of money is paid would be found in which type of loan? A. Blanket loan. B. An adjustable rate loan. C. A construction loan. Or D. A term loan. So for this question, I would only really know this by canceling out B through D. Blanket loans apply to multiple loans, so I guess the trick here is to look for the word parcels. So there may be more than one loan. I don't know. This one is hard, but B through D don't really make any sense. Question 51. All of the following would be considered operating expenses in the calculation of net operating income except A. Property management fees, B. Principal and interest for loans on the property, C. Liability insurance, or D. Maintenance fees and costs. So operating expenses are expenses to manage the property, to operate the property. Principal and interest for loans is subtracted out of the net operating income and helps you get your cash flow. So it's not here. The answer is B. Principal and interest for loans on the property. Question 52. A loan in which the lender makes a regular periodic payments to the borrower is best referred to as A. Graduated payment loan, B. Negative amortization loan, C. Reverse annuity mortgage, D. Wraparound financing. So usually you pay the lender payments, right? When the lender pays you, that's the opposite. That's a complete reverse annuity mortgage. Answer is C. According to the Real Estate Settlement Procedures Act, the lender is required to furnish the borrower with a good faith estimate of closing costs, A. At least 5 days prior to closing, B. At the time of loan approval, C. Within 3 business days of loan application, or D. No later than 5 days after the closing. So lenders these days are extremely slow, but it is supposed to be within 3 days. When in doubt, hit 3 days. All right, question 54. All of the following entities operate in the primary mortgage market except A. Commercial banks and lenders, Wells Fargo, Bank of America, things like that. B. Pension plans and insurance companies. C. Credit unions and savings institutions. Or D. Fannie Mae and Freddie Mac. So A and C here are pretty much the same. Commercial banks and lenders like your Wells Fargo and your Bank of America. And C, credit unions, it's essentially the same thing. So your regular banks are in the primary market. Fannie and Freddie are in the secondary market where loans are bought and sold. So you get a loan from Wells Fargo, hopefully not, and then they just end up selling it to a secondary market. Question 55. The Federal Reserve sets or regulates all of the following except A, the discount rate, B, assets and reserve amounts for banks, C, federal funds rate, or D, interest rates charged to consumers. So the Federal Reserve sets rates charged to banks, not the rates charged to consumers. So the answer here is D, interest rates charged to consumers is not regulated by the Federal Reserve. Question 56. In appraising, with which of the following properties would an appraiser be most likely to use the cost approach? A home that is older than 40 years. B, a 4-unit investment property. C, a one-of-a-kind shopping mall. Or D, a municipal building. So A is a standard comparison approach. B and C are income approaches because they are money generators. D is a government building. There's probably only one like it, and although the government sucks up your money, they aren't really income generators. They're not supposed to be. So the answer here is D, a municipal building. Question 57. A landlord can utilize the tenant security deposit for all except which of the following? A, punitive damages due to wear and tear. B, non-payment of rent. C, cost of re-renting the property. D, liens against the property incurred by the tenant. So normal wear and tear is acceptable from a tenant. Therefore, we can't charge for that. So the answer there was A. Question 58. Jill is an unlicensed employee for a property management entity. Which of the following is Jill not permitted to do under North Carolina licensing law? A, show units to prospective tenants. B, collect rents and late fees from current tenants. C, explain lease provisions and have tenants sign leases. Or D, negotiate a reduced amount for a security deposit with a prospective tenant. So unlicensed employees can do all of these except negotiate. D. Or skip at 59. Question 60. The loan clause that most likely would prevent the grantor and grantee from selling a property without paying off an existing mortgage would be A, acceleration clause, B, subordination clause, C, encumbrance clause, or D, alienation clause. Just by pure definition, the answer here is D, alienation clause. Alienation clause is between the borrower and the lender and states that the mortgage must be paid in full before you transfer. It's just terminology on that one. Question 61. Which of the following is an accurate statement when using the comparison method of appraising? A, the adjustments are always made to the subject property. B, the inferior comparables are always adjusted downwards. C, the three comparables are averaged together to achieve reconciliation. D, the property with the fewest number of adjustments is most similar to the subject property. So when using the comparison method, we are comparing similar properties. Adjustments are made to the comparable, not the subject property. If an inferior comparable is worse, you raise the price. C is irrelevant, D is the answer. The property with the fewest number of adjustments is most similar to the subject property. Question 62. All of the following advertisements would be considered to contain a trigger term under TILA except A, low monthly payment of $650. B, low interest rate of 5.8%. C, competitive APR of 7.8%. Or D, own a home for just $10,000. So TILA requires a rate for advertisements. Which rate? The annual percentage rate, the APR. The answer here is C. Question 63. Jerry was renting a residential property. At the beginning of a 12-month lease term, he had paid the landlord a total of $2,000 as a security deposit. Halfway through the lease, Jerry died. What is the correct disposition of the security deposit and the lease agreement? A, the lease is terminated, but the landlord may keep the security deposit. B, Jerry's estate is liable for the lease obligation and the landlord may keep the deposit and apply it to unpaid rent. C, the lease is terminated and the landlord must return the deposit to Jerry's heirs. Or D, the lease and the deposit must be turned over to the probate so they can be distributed to the proper heirs. When a tenant dies, there are still obligations that must be met, unfortunately. Jerry's family now must pay up. With that info, the answer here is B. Jerry's estate is liable for the lease obligation, and the landlord may keep the deposit and apply it to the unpaid rent. Question 64. When the landlord breaches a lease, the tenant is entitled to A. Constructive eviction, B. Actual eviction, C. Punitive damages, D. Summary ejectment. So this is vocab here. When a landlord breaks an agreement, as we talked about in a previous question, or they don't do something that they promised to do, a constructive eviction is allowed by the tenant. Answer here is A. Question 65. Under the North Carolina Tenant Security Deposit Act, the maximum amount of security deposit that can be collected from a tenant when the term of a lease is for 1 year is A. 2 weeks rent, B. 2 months rent, C. 1.5 months rent, D. 1 month's rent. So this is asking, if someone has a year term or longer, what is the most amount of security deposit that the investor can accept? So you should memorize the different deposits for different terms here. So a 1 year and above term is maxed out at 2 months rent. Answer here is B. Question 66. A homeowner has sold their property for $236,500. The closing date is March 5th. Their listing agreement requires a 6% commission, which is split with a buyer representative. They owe $142,400 to the lender. They are required to pay an $85 deed prep fee, excise taxes, and $450 for a home warranty at the time of settlement. The annual taxes are $2,800 and have not yet been paid. How much is the seller's check at closing? So collect all your information at first. Taxes are $2,800, but only paid till March 5th. That is $505. Right? You can get the monthly amount of $2,800 by dividing 2,800 by 360 days and then multiplying that by the amount of days the seller owned the property, which is 2 months and 5 days. So 6% commission is $14,190. Excise tax, which they kind of snuck in there. They didn't give you a dollar amount there. You have to do the math here yourself. Excise tax is $473. And you get that by every $500 of the amount, it's $1. So take the purchase price and subtract what they owe the lender and the other fees to get the $78,397. Answer here is B. Question 67. The best definition of an estate for years is a leasehold interest that A. exists for a period longer than 12 months, B. requires notice to terminate the agreement, C. contains a definite period of time, D. contains periodic automatic renewal provisions. So just think about your typical rent. You set a move-in date and a lease-in date right off the bat, right out the gate. That puts us at C. Contains a definite period of time. Question 68. What is the primary source for the rules that regulate the obligations and duties property owners and tenants owe to each other? A. Fiduciary obligations. B. Provisions in the Residential Rental Agreements Act. C. The North Carolina Real Estate Commission. D. Basic obligations owed to customers. So fiduciary obligations are what agents owe to their clients. So no, it's not the NCREC and it's not C. And property owners are not really customers to a manager. Answer here is B. Provisions in the Residential Rental Agreements Act. Question 69. What would be the proper closing disclosure entry when a borrower assumes a mortgage obligation of the seller? A. Credit the seller and credit the buyer. B. Credit the buyer and debit the seller. C. Credit the seller and debit the buyer. D. Debit the buyer and debit the seller. So a mortgage obligation is where the seller still has something left to pay on the mortgage at closing. Therefore, that money will be credited to the buyer and debited from the seller. This is similar with liens. So answer here is B. Credit the buyer and debit the seller. Question 70. The type of agency agreement that exists between a property manager and the owner of the property would best be classified as implied agency, exclusive agency, general agency, or special agency. So if you've followed along with all my chapters, we mentioned this probably 4 or 5 times. Realtors are special agents, so cross off D. Property managers are general agents. They have some power. Answer here is C. Question 71. A property has total rents that are being produced in the amount of $74,400 per year. The property has monthly expenses of $5,000. If the property is placed on the market at a list price of $240,000, what is the cap rate for the property? 15%, 6%, 60%, or 0.06%. So the total yearly profit is $14,400, right? That's $74,400 per year, but then you need to subtract out all those monthly expenses of $5,000 a month. $5,000 a month is $60,000 a year, because 5 times 12 is $60,000. So $74,400 of income minus $60,000 of expenses leaves you with $14,400. So then you take that income, you subtract the expenses. So $14,400 divided by $240,000 is 6%. And if you're asking how I knew to divide, well, try to multiply and you'll get some astronomical number. So we get 6%, which is B. Question, whoa, that's it. We have now basically taken the full real estate exam together. Practicing with some of these questions is one of the best ways you'll familiarize yourself with some of the questions that they're going to ask on this exam. I will be breaking out each chapter set of questions here in future videos, so those videos will be so much quicker than this one. And all of the questions will be different than the questions asked in this video. If you find any mistakes in this video, please comment them down below. Help out me, help out your fellow realtors. I hope this helped. There's still so much more to come. Again, if you have any questions on brokerages and firms, what questions you should ask, how to choose them, shoot me any of those to my email down below or to my Facebook Messenger. I respond to both of those fairly quickly. Thank you so much. Remember to subscribe, give this video a thumbs up. I will see you all in the next one.